This is the story of how money went from being something real to being nothing more than a promise, and how that transformation created the exact debt trap we're living in today. As anthropologist David Graeber explains in Debt, the first 5,000 years, before there was money, there was debt, challenging the conventional story that money emerged simply to replace barter. Before coins or paper money existed, communities ran on trust. People used simple promises called I owe us, meaning I owe you. You received something now and paid it back later. No cash, just shared understanding. As societies grew, these promises scaled, and what started in small villages became the foundation of empires and modern finance. Once those in power learned that controlling debt meant controlling wealth, the system never stopped expanding. To understand how this machine truly began, we need to start at the beginning. Before formal money systems existed, most small communities did not rely on constant barter. Instead, people lived on reputation, obligation, and informal credit. Who owed what to whom was understood socially rather than settled immediately in trade. Direct barter did exist, but mostly in limited situations or between strangers, not as the foundation of everyday economic life. As societies grew larger and trade extended beyond close-knit groups, these informal systems became harder to manage. To support taxation, long-distance trade, and exchanges between people who did not know each other, communities adopted widely recognized objects, such as shells in some regions, as a shared medium of exchange. These items made obligations transferable and allowed value to be stored and exchanged more easily across time and distance. Once people started using tokens as money, certain characteristics became obvious through trial and error. Barley was too heavy to carry long distances, so it failed the portability test. Whales' teeth couldn't be split in half for smaller purchases, so they failed the divisibility test. Shells could become abundant if supply routes expanded, which eventually weakened their scarcity and reliability as money. Kings noticed that having lots of money made you powerful, and power could get you lots of money, so they hit on the idea of minting coins from precious metals and stamping them with an official seal that guaranteed their weight and value. Metal money solved every problem at once. It was portable, divisible, scarce, durable, and had intrinsic value that worked for international trade. But success brought temptation, and sovereigns quickly realized they could shave down the coins or mix in cheaper metals, which let them create extra money by circulating debased currency worth less than its face value. Carrying large quantities of metal coins was exhausting work. In China, early forms of paper money evolved from merchant receipts and credit instruments that were later adopted and regulated by the state, allowing traders to avoid transporting heavy metal coins over long distances. Paper had zero intrinsic value, but people trusted it represented real gold or silver sitting in the treasury that they could exchange it for any time they wanted. As global trade expanded, the paper money idea spread, but traders worried it was too easy for rulers to just print more paper. So they tried linking paper currency to a fixed amount of gold, which created a standard for exchange between different currencies. Attempts to maintain this gold standard continued for centuries, but governments always abandoned it when they needed flexibility to print more money. And in 1971, the United States suspended the dollar's convertibility into gold. By 1973, the fixed exchange rate system collapsed, and in 1976, the post-gold monetary system was formally recognized. Years ago, on the Pacific island of Yap, the local version of gold was the rye stone, which was notable for being so enormous and heavy that once you placed it somewhere, it never moved. When chiefs decided to collect taxes in rye stones, they made the currency universal, unavoidable, and under their complete control, because everyone needed rye stones to pay their tax bill. The most valuable rye stones weighed several tons, so instead of physically moving them around the island, ownership was tracked socially. Rye stones functioned as a shared public ledger, showing that money can work through collective agreement without constant physical exchange. In the 16th century, Spanish explorers brought home massive supplies of gold and silver from colonies in the Americas, which seemed like a dream come true that should have boosted trade and made everyone wealthy. But what actually happened was that traders simply raised their prices to match the new purchasing power. So the returning explorers gained nothing from all that gold, and people without access to the new money were worse off because everything cost more. The only people who benefited were those with debts, because their debt payments stayed the same while prices rose, making their debts effectively smaller. This demonstrated a pattern that too much money chasing too few goods causes inflation, unless producers increase output to match the money supply, or unless the money circulates less rapidly because people save more, either because they're wealthy enough to save or because they're gloomy about the future and hoard cash. Inflation wasn't an accident. It taught governments something powerful. You don't need force to transfer wealth. You can do it by changing the value of money itself. And once that lesson scaled beyond borders, money stopped being just national and became a tool of global power. If this is already changing how you see money, keep watching, because what happened next reshaped the entire world economy. In the 18th century, Britain forced its American colonies to pay taxes in British pounds and made it illegal for colonists to print their own currency, which meant the colonies had to trade with Britain to access the pounds they needed to pay their tax bills. Benjamin Franklin later argued that British restrictions on colonial paper money were a major source of resentment, though they were one of several factors contributing to the American Revolution. This success led many countries, including Britain itself, to store large reserves of dollars. But by choosing to keep reserves in dollars instead of gold or their own currency, these countries handed power back to those runaway Americans. Having the world's reserve currency gives the issuing country extraordinary power because it can borrow far more than other countries and can print money when it runs out, which is exactly what happened when Nixon ended the gold standard in 1971. By the 19th century, banking had become thoroughly respectable business, making profits through basic money lending by paying depositors a lower interest rate than they charged borrowers. But banks soon discovered that as long as depositors didn't all demand their money at once, the system remained stable. When banks issue loans, they create new deposit money in the process. As Sir Mervyn King, the former governor of the Bank of England, explained, when banks extend loans to their customers, they create money by crediting their customers' accounts. Lending is not limited by existing deposits, but by capital requirements, regulation, and risk management. On rare occasions, when depositors rushed to withdraw everything at once, there was a run on the bank that threatened the wider economy. Governments responded by ensuring customer deposits to prevent panic and stabilize the financial system. By the 21st century, some banks had taken this to an extreme, funding most of their loans not from cash deposits, but with loans from other banks, often secured against bundles of previous loans. So when Northern Rock faced a run in 2007, the bank didn't have enough money to pay depositors, and the effect spread far beyond just one bank because the entire system was interconnected through these loan chains. To understand how governments prevented total financial meltdown after 2008, you need to distinguish between two kinds of money. Money created inside the banking system by banks making loans, and public debt created when governments raise funds by selling bonds. When a bank creates money by issuing a new loan, the bank acquires a new private asset, which is the loan itself, with an equivalent private liability to the borrower, and this creates money inside the system. Governments raise funds by selling bonds, which exchange existing money for government debt. Think of a government bond like a mortgage on future tax revenue. When you take out a mortgage, you receive cash today and promise to repay it over time using your future income. Governments do the same thing with bonds. They get money now from investors and pay it back later using taxes that haven't been collected yet. Public debt isn't abstract. It's future wages, future business profits, and future consumer spending already spoken for. New money is created primarily when banks issue loans or when central banks create reserves to purchase assets. Although public debt normally represents a tiny fraction of the total money circulating in the economy, it became far more significant after 2008. After 2008, governments and central banks stabilized the financial system through bailouts, guarantees, and central bank asset purchases, shifting risk from the private sector onto public balance sheets. After the suspension of the gold convertibility in 1971 and the collapse of fixed exchange rates by 1973, the world has continued trading in US dollars, even though these dollars aren't backed by anything of intrinsic worth. When the U.S. government borrowed heavily for bank rescues and stimulus after 2008, and the Federal Reserve expanded the money supply through large-scale asset purchases, many predicted the dollar's value would collapse. That prediction was based on the idea that economies which print money so they can consume more than they produce will suffer price inflation and exchange rate depreciation. But more than 15 years later, that collapse still hasn't happened. The dollar retains its value because so much of the world holds its wealth in dollar assets. That shared dependence creates confidence that the dollar will remain strong, and the knowledge that millions of others share that confidence reinforces it. It's a self-fulfilling system. The dollar has value because people believe it has value, and people believe it has value because they see everyone else treating it as valuable. Minted coins and paper money, once cutting-edge technology, now represent only a small share of the total money supply in many advanced economies, with most transactions occurring electronically. Digital technology is enabling new currencies like Linden dollars, Bitcoin, and other cryptocurrencies, which exhibit the same enduring characteristics that made ancient money work. They're hard to forge, durable, portable, divisible, and limited in supply. These new currencies may even challenge the power of government-backed money, but until a government accepts taxes and bitcoins or banks start lending in them, they're not much different from whale's teeth. One clear sign that a new form of money has become important will be when governments and banks try to control it. And if governments and banks continue to have the power to control money, those who use it will always wonder to what purpose they'll put that power. The pattern is simple. Every form of money begins as something tangible or socially grounded, then transforms into a promise backed by trust, and eventually becomes largely debt-based as systems expand. This exact sequence happened with metal coins, with paper currency backed by gold, and now with digital dollars, created primarily through bank lending and central bank monetary operations. Let me leave you with 3 principles. First, money has value only because people believe it has value, and that belief can disappear faster than the money itself. Second, whoever controls the money supply controls the economy, which is why governments and banks will never voluntarily give up the power. Third, debt and money are the same thing, which means in modern economies, most money is created through lending, which ties money creation closely to debt. When bank loans are repaid, that deposit money is typically extinguished. These patterns have repeated for 5,000 years. They're repeating right now, and they'll keep repeating because the machine works the same way every time. If this changed how you think about money, debt, or power, stay with us. Because once you understand how money really works, you start seeing the modern world very differently. And in the next part, we'll look at what this system means for the future.